In this video, we're going to cover the 5 main operating fees or expenses associated with investing, whether that's individual stocks, bonds, ETFs, mutual funds, or index funds. First up, trading commissions. This is the most basic fee associated with investing, but luckily it's the easiest one to avoid. Essentially, a trading commission is a flat fee charged by your brokerage every time you buy or sell shares of a stock or a fund. Back in the day, investing was not done online. You had to call your brokerage and ask them to initiate a trade for you, and a real live person would then go and do that, which came with a fee. However, because now pretty much everything is automated online, brokerages are staying competitive by offering commission-free trading. If you invest with a major brokerage, it's actually pretty rare to be hit with a trading commission fee, especially when you're investing in index funds, mutual funds, and ETFs. Some of the big names in the industry like Charles Schwab, Fidelity, and Vanguard all offer commission-free trading, as well as many others. Next, there are the brokerage fees. The main brokerage fee is a flat fee, usually charged on an annual basis to cover the administrative costs associated with hosting your investment account at a certain brokerage, usually in the range of about $25 to $100. Like trading commissions, however, it's pretty rare to see this fee nowadays, as many brokerages waive it in order to stay competitive. That said, there are additional brokerage fees that you may be responsible for based off of certain activities. For example, some brokerages will charge you a small amount if you elect to receive paper statements rather than electronic statements. Other brokerages might charge you if there's no balance or no activity in your account over a certain period of time. Since there are so many brokerages out there fighting to stay competitive, it's pretty easy to find a brokerage that doesn't charge all these annoying administrative fees. So like the trading commission fees, these are pretty easy to avoid if you just do some shopping around. That said, this advice only applies to investment accounts that you manage yourself, like IRAs and brokerage accounts, and not something like a 401k that's managed through your employer. For these accounts, you're typically not allowed to just shop around for a new brokerage. You have to just use the brokerage that your employer has selected to be the 401k provider. Every 401k will be different, but typically they tend to have a small amount of brokerage fees. Keep in mind that, at least in my experience, 401k providers will typically increase their brokerage fees pretty heavily if you move on to a new employer and don't roll over that previous 401k to your new employer's plan. If you think this might be impacting you, I have another video, which I'll link above, on what to do with your old 401k so that you can avoid these high brokerage fees. The next fee is associated with any fund-based securities, meaning index funds, mutual funds, and ETFs, and that's operating expenses. Operating expenses for a specific fund are generally represented as an operating expense ratio, or OER. You'll often see this shortened to just expense ratio. This is what the fund charges for administrative fees and portfolio management, essentially all of the activity that it takes to decide what goes in a fund and maintain it. To be clear, this is not what your brokerage charges. If they wanted to take money from you, they would charge you either a trading commission fee or a brokerage fee. The operating expenses go straight to the fund manager. However, if your brokerage is managing the fund, say for example that your investment account is with Charles Schwab and you're investing in a Schwab managed fund, the money obviously ends up in Schwab's pockets anyway. The expense ratio is the annual amount that your fund charges as a percentage of the value of your shares. For example, say you have $10,000 invested with an index fund that has a net operating ratio of 0.05%. That means over the course of the year, you would pay $5 towards operating expenses. Actively managed funds, generally referred to as mutual funds, where the decisions about what goes into the fund are made by a real live person, or rather usually a whole team of real live people, these funds tend to have higher operating expenses, understandably because they need to pay the people involved in making those decisions. Passively managed funds, on the other hand, like ETFs, where the decisions about what goes into the fund are made by a computer or an algorithm, these tend to have lower expense ratios because, well, you don't need to pay a computer. And of course, individual stocks don't have any operating expenses associated with them because it's just one stock. It's not a fund or a portfolio that needs to be managed. There is a fourth fee that's really important to consider as well, and it's called the bid-ask spread. The bid-ask spread is an interesting result of the stock market being driven by supply and demand. It's essentially the difference between the highest price a buyer is willing to pay, called the bid, and the lowest price a seller is willing to accept, called the ask. Why don't these numbers always line up? Well, with how digitized trading has become, it's easy to forget that there's a set number of shares out there in the stock market for any given stock. and these shares are constantly being sold and bought by real live people. If someone's confident that a stock will continue to increase in value, well, they'll be okay paying a seller's ask price even if it's a little bit higher than what they were originally willing to buy at, because that means they get to jump in front of the line in front of all the other buyers and get a hold of that stock first, similar to kind of how an auction works. Similarly, if a seller thinks a stock or fund is going to nosedive very quickly, they're willing to sell at a buyer's bid price, even if that means accepting a little bit less money than if they were to wait around and see what happens and see if any other buyers will be willing to take their ask price. And the more you trade, the more transactions you have, the more this bid-ask spread will be relevant to your overall portfolio performance. Choosing more popular stocks or funds will help keep the bid-ask spread very, very low, almost to a negligible amount. The more often a stock or fund is traded, or the more liquid it is, the smaller the spread between the bid and ask will be. When researching funds, be sure to look up the median bid-ask spread over a certain period, usually a year, to help you make an informed decision. That said, there are ways to mitigate this bid-ask spread, like transacting using limit orders, which I covered in another video and I'll link above. The fifth and final cost of investing that you should consider is potential changes in net asset value. This is the price of a single share of your chosen mutual fund, index fund, or ETF. The net asset value is ultimately the primary reason we all invest. We want the value of our shares to go up over time. When people talk about the risk associated with investing, they're usually talking about the possibility of a portfolio value decreasing, which happens to nearly everybody when they're invested in the market during times of recession, like the global housing crisis of 2008. What's important to remember here, however, is that it's not a realized loss until you actually go to sell. Crashes happen. It would be foolishly optimistic to think that a crash is never going to happen again. But historically, the stock market has always recovered after a major crash. Many people lost everything in 2008, not because their portfolio dropped in value, which it did, but because when it did, they panicked at the bottom and sold at a huge loss, or they were over-leveraged, or they lost their job and they just needed to pay their bills to survive, regardless of taking a huge loss from the stock market. On the other hand, people who had investments in the stock market in 2008 who were not over-leveraged and did not panic sell when things started going south because they had an emergency fund and extra cash to kind of weather them through the hard times, those investors are probably doing very well for themselves based off of the stock market growth over the last 15 years. However, it is important to note that past performance is not indicative of future performance, and ultimately, if you choose to invest in the stock market, you are accepting some amount of risk that your portfolio could decrease in the future, even if you accept that that risk is not very large. And there are ways to mitigate this risk by thoughtfully choosing your investments. Index funds, for example, tend to fluctuate less than individual stocks, and investors nearing retirement can weigh their portfolio more heavily in bonds, which tend to be a lot more stable than other securities. So to sum up, the 5 main costs associated with investing in the stock market are first, trading commissions, which are charged by your brokerage as a flat fee when you buy or sell shares of securities. Second, brokerage fees, which are flat fees charged by your brokerage to cover administrative and maintenance costs regardless of trading activity. Third, operating expenses, which is what your fund charges as administrative fees as a percentage of your total investments. Fourth, the bid-ask spread, which can cause your portfolio to suffer over time if you're trading very frequently on stocks or funds that are less liquid than others. And fifth, changes in net asset value, or the value of your shares going up or down over time. If you learned something from this video, please consider giving it a thumbs up. Consider subscribing if you want to see more personal finance content like this. And thanks for watching, and I'll see you all next time.